let's take a deeper dive into what happened to savings and loan institutions. In the early days of banking, most individuals did not need bank accounts. Those were reserved for the wealthy, and those who wanted to buy a house still needed a home mortgage loan. But back then, mortgages were offered by insurance companies, not by banks, and they were very different from what we know today. We'll cover mortgages in much greater detail in an upcoming lesson, but knowing a little history here can help you to understand how banks evolve over time. Typically, the loan to buy a house was for a short period of time and might be an interest-only loan, meaning that with each payment the home buyer was making to the insurance company, they were paying interest, but they were never actually reducing the initial amount that they owed, which is called the principal. Some loans also had a balloon payment at the end, meaning after many months of making regular payments that were the same amount each month, the homeowner suddenly had to come up with the money for one very large payment to close the loan and finally own their own home. As you might imagine, these types of loans meant that many people were never able to fully pay off a mortgage and own their home, and often this ended in foreclosure. During the Great Depression, the government sought to change this pattern. With the Federal Home Loan Bank Act of 1932, mortgages began to shift from insurance companies to banks, and savings and loan associations began to grow across the country to take advantage of the low-cost funding that the Government Act offered. But in the evolution of banking, things are constantly changing. In the late 1980s and early 1990s, more than 1,000 financial institutions failed, approximately 1/3 of all the savings and loan associations in the United States. This crisis occurred because changes in federal laws meant that savings and loan associations were able to expand rapidly with less regulation or oversight from the government. When there were changes in federal interest rates, many savings and loan institutions were paying more to the government to borrow money than they were charging their customers to loan them money, meaning they weren't making money and they needed to try and acquire funds through some very risky investment strategies. The FSLIC, the Federal Savings and Loan Insurance Corporation, and the Resolution Trust Corporation eventually stepped in and ended up closing more than 700 of the failed institutions who could not meet their obligations to customers. The General Accounting Office of the U.S. government estimated that the total cost of the savings and loan crisis was about $160 billion, and more than 80% of that was funded by taxpayers. As a result of the crisis, the number of savings and loan institutions in the United States, which was already declining sharply since the 1960s, began to dive even further. As other financial products and services have evolved, and mortgages are more widely available through banks, credit unions, and mortgage companies, the limited service focus of the savings and loan institutions is no longer as widely sought out by consumers.